This is a short webinar to discuss our latest investment offering that we've brought out on Valor, together with our partners Garrington Capital and RainFin. I will be talking a little bit about what is USDPC. We'll be talking about tokenization and doing a deep dive into how the yields are generated in this strategy. So I'll quickly move on and start with introductions of who you're talking to today, and then we'll climb into the details. So briefly, my name is Blake. I'm the Chief Commercial Officer here at Valor. Valor is a digital assets exchange. We're headquartered here in South Africa and have been in business now for about 7 years. We are the largest exchange in South Africa and are fully licensed operator under the law here, as well as in a few other markets, and are right now the only place you can trade USDPC against stable coins. And we're really excited to be here on the call. I'll hand over to Sean to talk a little about RainFin, and then to Tori to talk about Garrington. Go for it, Sean.
Thanks, Blake. Yes, I'm Sean Emery, as you said, the CEO of RainFin. RainFin is South African based. As you said, we're based in Somerset West. We've been involved in the tokenization of instruments really for the last 4 years now, in terms of researching them, putting them out to market, testing them, getting them through their various phases, getting all the approvals required. It's been a lot longer than you might assume to get these things out there, but we're finally there, and we're very grateful for presenting this to everybody today. It's the first token that we've done on Valor. We provide really our main mission is around revolutionizing the financial aspect, try and bring your very unique assets to an audience that is on Valor. And we hope this is a first one of many, and it's a great and a very exciting one. And we're so pleased that Tori can join us around Garrington Capital. RainFin has been a specialized entity in the past around creating various debt products. So we really understand debt, and we understand private debt really, really well. And when we came across Garrington, we were very excited about this industry, about the products they've got, the stability of the organization. So we thought it was a great combination, our tokenization experience and their deep capital the deep lending and debt experiences. So over to you, Tori, about Garrington Capital, if you don't mind. I'll just get a segue through to you. Thanks.
Thank you. Garrington Capital, private lender. We've been around for 25 years. Trading proprietary capital up until 10 years ago. I got involved with the company 10 years ago. I have an investment background in hedge funds and mutual fund industry. So for the last 10 years, Garrington Capital has also been managing capital for third parties, and I believe the track record has been shared with you. We have about 60 employees across North America, split evenly between the US and Canada. Head office being in Toronto.
Awesome. Thanks, Tori. Yeah, very exciting to partner with you both. It's been a long conversation and lots of iteration in bringing this to market. So it's been very exciting to finally see this go live. I know Sean and I had conversations about this years ago, and it's quite surreal to finally see something like this hit the shelves. So very excited to dig into it. I've obviously mentioned both RainFin and Garrington, partners of Valor. He has just a few of the other partners that are involved in our day-to-day operations, as well as some of our investors. We're deeply involved in the stablecoin space. As you can see, we work closely with Tether and Circle, and some of our key investors, Pantera, Coinbase, Avon Ventures, a subsidiary of Fidelity, as well as GSR, and some of our banking partners present here. But we'll quickly get into the nitty-gritty of what this all is and what it's about. So I'd like to hand over to Sean just to talk about tokenized credits and generally the concept behind tokenized assets and what they've been doing at RainFin and how this came about. So Sean, I'll hand over to you for this section.
Thanks, Blake. Yeah, so I think the most important, when everybody talks about tokenization at the moment, people are, what is it? How does it really work? How are we going to involve in South Africa, and how can we get it into market? And our first premise at RainFin was to realize that although tokenization is effectively fragmentation, it's been around for a long time, this concept of taking an asset and then dividing it up into various components so people can have great exposure to it, and it can trade it and become more efficient, and it can operate. I think the important thing for us is once something becomes tokenized and it is actually placed on the blockchain, it then starts having a hold of other features which you can do with it. So the ability of the blockchain, given its tokenized assets, all those great features that we have with crypto assets, like the ability to send, to receive, to lend against, to lock, to redeem, to use in programmable contracts, all of those features start coming available and start ultimately coming to market. And that was very, very important for us. I mean, we really want to give investors an easy on-ramp to assets which in the past might have been traditionally unacceptable for them, or unaccessible to them, not acceptable, unaccessible to them. So when we look at what shares and the share exchanges, and my history effectively, just for this audience to know, is a quite long history with stock exchanges. I was for a period of time the CEO of the Cape Town Stock Exchange. And what shares did to companies when you had the ability to go and trade shares, the ability that created for companies to access capital and for markets to become liquid and for people to provide exits, those were amazing steps forward in the capital markets. And tokenization is ultimately, I think, 10 or 100 times better than that. The ability to actually go down to any traditional asset that's out there, being able to tokenize it, put it in various blockchains, and have the ability for people to utilize in their own wallets, and to ultimately give people choice, give the ability access, and the people to use as little as R1 to access an amazing fund like Tories. And I think, when I look at it in this context, and we say, for the first time, me as a South African, I can go on to Valar with my fiat. I can put 10 Rand literally into my marketplace in fiat. I know we've got a slight reserve and barriers which will over time reduce the like, but I can take 1,000 Rand, let's say, or 5,000 Rand, and I can have direct exposure to the great yields that are generated from lending capital to big organizations in America or in that are buying yellow equipment. It's like actually an unbelievable concept. Think about that we can have this exposure driven to the lowest common denominators here. We can trade it 24/7. We can have yields that are delivered on top of it, and the ability for us to, in time, have trusted partners in this chain where we can actually bring these opportunities, obviously not to only South Africans, but to any investor that's on the Valar market in any context. So have a partner like Valar is important for us. It's important for us to effectively have distribution with trusted partners, and those trusted partners have very good KYC and AML processes of bringing customers on board, so we ensure where they go. But ultimately, we're very focused on making sure we can bring the most unique type of assets to a unique audience. So I'm going to get later, I'll go into some of the structuring and how it's done and some of the frequently asked questions. But for all intents and purposes, we have to bring these opportunities in tokenized form to anybody in South Africa or anybody globally that has the ability to want to participate inside of them. So Blake, I think it's there's a lot on that slide. So I think we can go through tokenization in its general form, but I really do, as you say, want to dive into private credit. I think it's for us when we looked at the how to start tokenizing assets and to slowly introduce those to the audience as RainFin and obviously with our partners, we looked at what had been the best use case for tokenization at the moment. And if everybody talks about it, people will often think about the fact that stable coins is such a great example, right? It's the ability to create a tokenized asset that represents ultimately dollars, and it has all the benefits of trading it. So we saw a lot of people sitting with stablecoin, a lot of people using that as diversification out of their local currencies, a lot of people using it to transact. But stable coins didn't necessarily generate any yield for customers. They would have it in their wallets. I had some in my wallet, I parted some treasury wallets have got it, and a lot of people hold their tokenized US dollar stable coins. We then realized that there was a need to offer a yield to people who held stablecoin. But when we looked at the market and we saw there's different kinds of yield that we can bring to the market, and we got the most important thing when we started out and we launched our first flagship product was to bring something out which had a great return for people but didn't have a significant amount of risk. I think we've gone back one, but if you go forward one again. So there were movements around US dollar treasuries. And I think there was a great first move in US dollar treasuries. And we all know what happened to BlackRock and others about doing that out in treasuries. Those returns were around about the 4%, and perhaps they'd come out more, and the treasury product for us. But a private credit product for me, especially with RainFin's deep experience in credit, is always one of those aspects where the yields are great. The right partners, if you can choose the right partners, the risks are reduced. And I think a yield of between 8 to 10% on a product for us is a great yield given the risk profile where we can come in at. We want to do something which was generic, something was US dollar based. Okay, it was our choice. We could in time do ones that are other denominations as well. But US dollar, because of the time to the stable coins, made a lot of sense to us. We knew that we would have to have a strategy and a manager of that strategy, and we really liked the Garrington strategy. So when we went to market and started to build the US dollar private credit, we have a great partner in Cape, which is a company which is Stephen, as you got Stephen Pratt, who's hopefully on the call and can answer some of the questions as well. But he brought Garrington to us as an entity which they had done such deep research on. A lot of pension funds in South Africa had invested into their strategy and had used them in a management point of view. So we engaged with them, and we spent about a year evaluating Garrington, looking at all of the pieces of it, how it worked, how they did their research, where they were. We opened a lot of folders of research and due diligence on them, but effectively it became the provider of choice for us and the manager of choice. And we really loved the strategy that Tori's got. So we wanted something with this low correlation. We liked the fact that it was highly secured. We got a very good liquidity structure with them. I know in an ideal world, we would have liked instant liquidity. We'll still create those markets in time to create instant liquidity for people, perhaps create pools, and we'll develop this product in time. But today, effectively, the ability to give someone liquidity on a product within 30 days was a target for us. We think it's highly, it's baked into our model with them now. So it's baked in, we can do it within 30 days. Also, to potentially accelerate that to within 7 days is really important. So we've got a commitment to do it within 7 days as well. So we like to say we hope to target 7, but obviously they have to put out their dates of 30. And in time, we'll obviously try and bring that number down to get it out in a more instant process point of view. So it's overarchingly, it was a long choice in looking for Garrington. But private credit and US dollar are big asset classes, Blake. They're asset classes which are going to grow significantly, and we want to get into that space and bring those to an audience around the world. And if you look at the markets are a bit uncertain. You can get into shares however you want to get into shares. You can buy shares on any other platform. But this for us is a great platform to get involved. You can also buy treasuries and other platforms. It was something which was unique, something which people could easily access, and we wanted to put that into a tokenized form. So I hope that addresses your question on why US dollar private credit.
Yeah, exactly, Sean. I'm sure we'll get into why private credits and the work that Tori and team have been doing a little bit later. But maybe I'll quickly jump into the nitty gritty of it. And yeah, absolutely, we are working quite closely with Sean and Tori and the team to create as liquid of a product as possible. And the hope is that eventually we'll be able to, and hope very soon actually, we'll be able to provide with basically immediate liquidity for reasonable sizes and for larger size redemptions, as Sean said, 7 to 30 days. Sean, I don't know if anything else you want to cover on the fund, I think to fund the token itself and what you've put together, particularly how you've structured it.
So let's talk about, there isn't a slide on this from a legal point of view and from a structuring point of view from South Africa, but I'll just talk about it. I think there's a couple of things which are quite important to people. People always ask me this question. They say, what actually is the token legally? What is the token? They ask me this question. Like if I have the token, what have I bought legally? And legally, what you're buying, and we own this token, is you have a limited partner certificate. So you have, that's in law what it is, you have an LP certificate into a private credit fund where we established a what we call an incommandite limited partnership. So it's a partnership. And that partnership invests in the Garrington strategy. So that partnership owns units. Every single time someone buys a token, cash goes into the fund, into the limited partnership, and the limited partnership buys units in the Garrington strategy. So we have a reserve on the page. If you go onto the RainFin page, you can have a look through all of the detailed structures. You can see exactly the on-chain reserves at any point in time for any token, what they're backed by the real-world assets. You can have a look at the structure, the legal framework that's on it. You can have a look at the terms and conditions of every token. But effectively, that's what you're holding. If you aren't holding a security, it was important, so we didn't trade securities. In South Africa, limited partnership certificates in the context were not securities, but you're holding this access to the limited partner token. And that was very interesting. I mean, it's a very interesting concept that South Africa has some globally acceptable laws which allow us to create this tokenized entry point that actually gives holders real value and real ability to come to an off-chain world and redeem if necessary. The question always asked is, if something happens to RainFin, what happens to the token? Is this whole token structure bankruptcy remote? And everything is completely bankruptcy remote. So we've created a very specific Garrington in comedy partnership. RainFin is, yes, we are the manager of that in terms of the general partnership. We've got an outside appointed structures that are CAPE is an outside appointed asset manager. And that fund is completely bankruptcy remote and completely removed from RainFin's balance sheet and the like. And this is a framework that we'll use again and again for other tokens as they come out. But that's the token which we've been utilizing. We've obviously spoken about that at length before in many, many other conferences and the like about the structures we're using around tokenization. But I'm happy to take questions on that.
Great. Thank you, Sean. We'll just we've summarized some of the key features of the actual product here in this table. Sean's gone through quite a lot of this already, so maybe I'll quickly just tick through some of the key parts of it from a product perspective. But obviously this is a crypto token. It exists on the Arbitrum blockchain as an ERC20 token. It is withdrawable and you can deposit it on Vala like you do any other token through our various user interfaces and APIs. We do provide a secondary market as well as a primary market for subscriptions and redemptions through our over-the-counter desk. There'll be more types of ways to trade this token in the future, and the token is repriced daily according to the NAV. So that is the value that you'll see on your Vala user interface when you log in and you look at the number of tokens and the total value of that will be calculated based on NAV, which is updated by the day. And likewise, that's how we process subscriptions and redemptions as with reference to the NAV of the fund or the net asset value of the fund. Of course, the issuer is, as Sean mentioned, the comedy type partnership, and we are distributing it. So right now, there is a minimum investment value. That is just because it is purely an OTC product for now. There will be other mechanisms to subscribe and redeem in the future, and that value is 5,000. We will, once it's available more generally through our UI, that will decrease, and the OTC minimum will increase. But for now, you're able to access this with as little as 5,000. If you had to go directly to the funds, I believe it would be more or equal to about $100,000. So this is just part of the ease of distributing that crypto gives us. It's as easy to buy this token from Vala as it is to buy Bitcoin or any other crypto asset. And that's what's really exciting about this technology. Likewise, our distribution partners and those, many of which I think are on the call here, those asset managers and others that use Vala as infrastructure are able to access this the same way that you access all of our other crypto products, and can access this product for your clients. And it is available through our API as well, and subscriptions, redemptions ultimately will be too. So that's just a quick note here. I don't know, Sean, if anything else you would like to add on the actual product structure.
No, that's perfect.
All right, great.
Thanks, Blake.
Cool. So I'll step in now and just talk a little bit about how you can get hold of this and how you can go about trading this token on Vala, how we price it, the various commercials involved, and then we can get stuck into how the yields ultimately are generated for this product. So at the moment, it is a product that is distributed exclusively through our over-the-counter desk, which you can access through our our website, you'll see there is a form available where you can get a quote on your subscription or your redemption order. That is available, as well as the fact sheet, on our support website, which we'll share links to after this webinar. And if you just type in USDPC Valor on Google, it'll actually come up right away. Right now, there is a minimum investment amount of 5,000 USDC equivalent. We do take both USDT and USDC, so we will seamlessly convert USDT as well at the going market rate relative to USDC. But if you do require stablecoin purchases in other currencies such as dollars, euros, pounds, or rands, our over-the-counter desk can also support you with acquiring that stablecoin first before you can get into the fund. But we will make it all quite seamless for you through our desk, and you'll see that we have an excellent OTC desk, and Yassine and the team work really hard to provide an exceptional white glove service for our clients. So there's a great opportunity for you to also experience that product of Valors. Likewise, on redemption, we will redeem the token again against NAV, and you can redeem it through a similar process to your subscription by either sending an email to OTC desk, contacting them on your OTC channel if you already have one set up, or contact me directly, and I'll put you in touch with the relevant people, and you can request a redemption. Right now, we are working hard to make this extremely liquid, so it is likely that we will give you extremely fast liquidity. In the future, if there are lots of redemptions, we may be forced to revert to sort of longer redemption times, but as Sean said, we're aiming to give you value with 7 days, but it may take a little bit longer if there's high demand or lots of public holidays and banking delays. But we're working hard to make this very liquid. On the secondary market, Valor is standing ready to redeem this much faster, and we will try to give you instant liquidity at a slightly further spread from the NAV, but we are doing our best to give you as liquid of offering as possible, which is amazing for something that is traditionally quite illiquid in terms of private credit. So this is our subscription redemption process. We'll of course available for questions, so please just type those in the chat or send them through to our team, and we can talk more about it in a moment. But it's quite simple. You can email us at otc@valor.com if you don't want to fill out the form, or contact us through help@valor.com, and it'll find its way to the right people. Just in terms of the costs, we right now are trading it at a 10 basis point spread to the net asset value price on the day, which is published daily, both on the RainFin website as well as on Valor. And we will take that off of your USDC amount before subscribing. Likewise, on redemption, we will take that on the USDC amount. Again, 10 basis points at this stage. For early redemption, so when we give you instant liquidity, we will charge a spread of 100 basis points or 1% to get you out of the fund in the token at immediately during our OTC market hours. This is all again done through our OTC channel or your OTC chat. Feel free to ask the team at any time. Even now during this call, you're welcome to subscribe on your various channels. The team is still online. I will stop here and quickly, maybe we can see if there are any questions before we move on to the next section. Ben and team, I don't know if there is anything that's come through. I haven't seen any burning questions, but I'll just pause for a moment. If there is nothing, then Ben informs me that there hasn't been any major questions. Oh, there is one. Why Arbitrum? This is the good one, Sean. Well, I think we should be aligned on this, but it'd be interesting to hear. So the answer is Byron. So we obviously support a number of blockchains. Arbitrum was at the time when we were having these initial discussions with RainFin the cheapest layer 2 on Ethereum that we supported USDC on, as well as ERC20 tokens. And we wanted to do this on a fast and cheap blockchain. Arbitrum is still a leading layer 2 that supports this type of use case, and we decided to go with Arbitrum. It's obviously been used by a lot of large use cases. I mean, the most famous at the moment being Hyperliquid, and has been a leader in the space for a while. Aside from that, a sort of convenience factor in terms of our technology and our tech stack that was already built on this. There isn't a lot more than that, but it does achieve its objective of being highly cost effective and fast for the use case that we have. All right.
Perfect. Leave it at that.
Cool. Okay. We'll move on. So I'll hand over to Tori now to speak a little bit more about Garrington Capital and the fine work that they do over there.
Great. Thanks, Mike. As I mentioned, the firm's been around for 25 years. We've been managing capital for third parties for 10 years. The track record that you see includes every transaction that's been done over that 10-year period. So it's all in there, good, bad, ugly. We have financed over $6 billion since inception. Loss rates over that period less than 50 basis points per annum. Again, split about evenly between Canada and the US. My background, which I think is relevant, we can go to the next page, Blake, but my background is that I've spent 34 years in the investment business, started out in long only, ran 2 Canadian hedge fund companies for about 15 years, raised billions of dollars in the hedge fund industry, had a really, really good experience. There's a lot of great qualities that can be achieved within hedge fund management and various hedge fund strategies. Really neat stuff. But no matter how good the manager, no matter how good the strategy, there's periods of underperformance, and those periods can go on for some time. And I would state that goes for all asset classes, or most asset classes. I just finished speaking. I'm in Brazil today, speaking to a group in Sao Paulo, and I was speaking concurrently with a representative from one of the largest bond managers in the U.S. And one of the stats he pointed out, which I found very intriguing, is that the U.S. bond market is in a 59-month bear market. We're 59 months in. If you bought just the corporate bond index in the U.S., drawdown of 17%, 59 months without a return. I mean, it's almost infallible that that's going on. In equities, people probably forget, but equity markets can go through flat periods for decades, really. And in the last 40 years, the S&P 500 has gone through a couple of 10-year periods of that. And the last one being 2000 to 2011, you had 11 years of negative equity returns and 2 blow-offs of greater than 50%. So my point on this slide, and why I joined Garrington and ultimately me and my partners bought the company 6 years ago, is we just love the risk-return metrics in what we do. This is a strategy that if you do it the right way, you can achieve equity-type returns higher than corporate bonds, while taking significantly less risk. Okay, it's not perfect. We're an open book. We'll walk you through some of the tough pieces to what we do. But generally, because of what we do and because of the yields that we get, we believe we can get these types of returns and not face a period year over year of negative returns. And there's very few investment strategies in the world today where you can do that. And if you do private credit the way we do it, senior secured asset-based lending, the right way, you can create much more stability and not forsake returns to do it. We can go to the next slide, bud. Okay, so very quickly, what does Garrington do? We do senior secured asset-based lending. It is the highest security level within the capital stack of a corporation. It is the safest way that you can make an investment. It gives you incredibly tight controls on companies. We do it solely in North America, where we are in a system where the legal system is very advanced and in favor of lenders. It's an incredibly safe way to invest if you are trying to invest in a corporation's capital stack in any way, shape, or form. if we go to the next page, Blake, this is really the money shot of what we do and where I'll spend the most amount of time. We have a complex strategy, but really in a lot of ways, I'm going to come to you, Sean, in 2 seconds. I'm just going to finish this one slide. But I will take your question. We have a complex business, but it's really as simple as what's on this page. We look for businesses or other lenders that have tangible assets. We then review those assets for assets that we are willing to lend against. We set a liquidation value on those assets by doing third-party field audits or having third-party appraisals of the assets. We then set an advance rate identical to what you would do if you went to a bank for a mortgage. We decide we're going to lend to that borrower, and we put a senior, almost always, today 99% of our loans, senior secured lien on those assets in the business. So you're getting controls within the business. Then we put covenants and controls above on the business or the lender. And that's how we box the trade. I would argue, and I'm going to elaborate on how we do it, I would argue this is so much safer than almost any type of public corporate bond investing, high yield bond investing, and definitely equity investing. Sean, ask your question.
Just for clarity's sake, just so people understand the definition story, South Africa is a very different definition on SME than you've got. I know you're significantly larger. Maybe you can just give us an overview of the size of companies we're talking about that are your clients.
Yeah, our tip is, so we do focus. We focus on loan sizes less than $30 million. It's part of our secret sauce. Typically companies that have revenue of 10 to $100 million US dollars. And we do it on purpose. We do it because it's a safer area of the market. We do not have to compete against the Apollos, the BlackRocks, the Ares, the Barings. It's a fragmented market, and we're able to get inside the asset and get a lower advance rate with a higher return in this level. So many people would think lending, I know in South Africa for sure, lending, and certainly in Brazil, where I heard a stat 18% of all private loans go into default and losses. Very, very different. We are lending in this space because there's less competition. We can get more asset coverage, and we believe it's significantly safer on a risk-adjusted basis, return versus risk. We believe so strongly we get a better unit of return versus the risk we take than if we were in the larger space. Does that answer what you're looking for?
Yeah, I definitely understand it. I think, in a tough environment, it's interesting on your previous slide, your returns actually accelerated post-COVID. So you went to a higher return in an environment where the banks would have pulled back. So they create a gap for you, I suppose, in that part of the market.
They do. I mean, it's interesting for fairness, part of the reason our returns went up is that the risk-free rate went up during that period. But we did hit, to your point, we hit an environment in the last 3 years where there was more risk of recession in both the US and Canada. There certainly was more financial risk. We were able to take our returns up by about 300 basis points per annum. We caught about 60% of the risk-free rate, yet our portfolio today is safer than it was 5 years ago because banks started to kick out borrowers. We were able to get a better quality borrower than before because of what was going on and still a higher rate. I will tell you, the premise of what we do, and you've heard me say this so often, we win by not losing. It's a saying that my staff gets sick of hearing, salespeople, credit people, but that's how we look at the world. We make every investment with the intent of not to lose a penny of capital. We're very, very selective. We typically see 100 to 150 loans a month. We pick 3 or 4. Our credit team, people often say, I hear it even internally, you can't get a loan done at Garrington. And I disagree. We get loans done because we have a very active pipeline, and we find little gems, sort of like sifting for gold. So we're very selective in what we do. Our controls are top level. We're typically doing weekly or bi-weekly reviews of the collateral. On over half our lenders, we actually have cash control or cash dominion. So we control the cash coming into the corporation, and then we evaluate the collateral and release back any excess collateral. We have very strong operational financial controls, as well as legal controls over the loan portfolio. This is high quality institutional investing, like what I have not seen in my career, representing
Perhaps you
dozens
could
of
talk to me
world-class hedge funds.
just a little bit about how we are able to have liquidity because of the length of these loans. Maybe that's something you just
Yeah,
next week.
no, it's a good point. I mean, our current duration, we have a portfolio that can be wound down in approximately a year from start to finish. It's a very diversified portfolio. Today, the duration is about 135 days. So you're looking at just under 5 months. We have large credit lines with big North American banks that provide a lot of liquidity, and every month we have money rolling through. I will tell you, the pools within the Valor RainFin portfolio token are a relatively small piece of our overall capital, and so there's a combination of bank lines, liquidity, and we're talking about a smaller percentage of our overall portfolio.
Blake, I think that's an important thing just to mention, and perhaps it doesn't come across significantly. Part of the reason that Garrington is focused on giving us this liquidity terms in the token is because we are effectively feeding into a much broader liquidity pool, they've got a big asset base, right? So the token represents a small slither at the stage of that big fund. So they are able to provide a certain liquidity, which perhaps you couldn't take if you were directly in the fund and you had a big portion of the fund. So those are the elements we've made very sure of, that we weren't isolated. We were very much part of the whole, or part of the whole process. It's important to.
Yeah, it is, and I think it's interesting. There will be a certain amount of capital on this particular product that we can take in and provide the liquidity exactly as has been described by Blake and yourself. Very, very comfortable with what's been set up, but because it is a smaller portion, it may be at some point you and Valor will have to work on a token too that has a longer type of liquidity, and that will just depend on flows in on both sides.
Great, thank you.
Oh, but it is really important. One extremely important point to do with liquidity. We do not believe in payment in kind. 99% of our loans are cash paying, and it's very important. We do not want our loans growing while collateral is slipping, which is different than a number of private credit providers. We're seeing 13-14% cash rolling through our portfolio, as well as another 10% coming due each month. So it's a high, relative to most other private credit strategies, it's a high turnover, very, very liquid strategy.
Great.
Sorry, I flipped through just because I thought it might be helpful for some of the facts there, but I'll go back to this, just maybe if there's anything you want to cover here.
Yeah, I mean, we can do it quite quickly. I mean, we focus on a sub 30 million market. No matter what we do, it's every transaction is very disciplined with regards to tangible asset coverage, average advance rate being around 60%. But then we're very flexible. We're flexible by type of senior secured loans. So you'll see on the left side of this chart, there's 5 different types or verticals of senior secured lending that we do. That's actually 7, because asset-based lending includes equipment lending and real estate lending. So we're flexible there. We're flexible by industry, and we're flexible by geography. We're virtually indifferent whether loans come from the U.S., Canada, state, or province. Part of our investment philosophy is to have the luxury of choice. and a great degree of flexibility. That being said, there are certain industries that we will not lend to because it's hard to really ascertain what the liquidation value of assets will be. So things like commodities, we don't lend to things in the ground, metals, minerals, oil, gas. We will not lend against those types of assets. We don't do much in the real estate development area because there's completion risk. We don't do a lot in the construction business because there's some risk to the progress billing cycle of receivables. So away from that, flexibility is very, very important to us, having the luxury of choice, and you make better investment decisions. That's all I need to cover on that slide, Blake. So target portfolio duration. This is a very short duration portfolio, typically 6 to 12 months. Today it's under 5 months. Typical average loan to value ratio, about 60% against the asset, very conservative. You don't get such low LTVs in the larger loan space. We typically have, it says 80 to 120, typically 100 to 150 loans in our portfolio. Today, 99% of the loans are first lien. These are target portfolio parameters. If we go to the next page, Blake, emulates what we look like today.
Like some of the point just for the participants is that the token is priced daily, which is unusual. People are going to ask, how that effectively is working, but we do an NAV calculation or net asset value calculation. We get ultimately from Garrington, we get that regularly. We get it effectively from the underlying administrator once a week. The internal days, we do a forecast of what they would be on a daily basis to get to that once a week, and then we true it up effectively on the day we get it from them. And that's a great way as well to effectively achieve the yield on a daily basis. People don't have to wait, obviously, for the full year to return it. It's a daily pricing, a daily increase in value, and therefore daily value attributable to them. That's also something unusual about the token. Yeah.
And just to elaborate that, Sean, our investment team is meeting. Everything in our portfolio is marked to market. So we're meeting weekly and evaluating any impairments and putting that into the NAV that's fed to RainFin.
Fantastic. Tori, maybe just one side is just if you could give some sense of the overall scale of your capital deployment. I know we've mentioned it sort of in passing, but maybe just to talk about the overall strategy and sort of the total amount of lending that's been done through the strategy over the years.
Yeah, I mean, we've processed over $6 billion of loans over the last 15 years or so. Today we manage and advise on about 300 million US. We feel that we have capacity for about $200 million a year of growth. There's probably $1 billion, if somebody said, here's a check, go find loans that fit this criteria. I think we could do it to the scale of $1 billion over the next year, but we could not process $1 billion of loans. So I believe about 200 million a year. And this is a strategy that probably caps out around $1 billion. We say loosely 750 to $1.5 billion, but I believe approximately $1 billion is what we can manage.
I guess it's also an important point, Blake, is that we've managed to secure a nice chunk of their forecast for the token. So we have the ability to scale it, but yet, of course, it's not unlimited. So we can go to 20 million quite comfortably without a conversation on any of the terms, dollars I'm talking about. So we've made sure that we've ironed out a slice for us of that future portfolio growth that's sitting inside there for us.
Yeah, exactly.
Now, I'm just conscious of time. Blake, how are things on your side there?
We're still looking okay. I will quickly go through the balance of the pages. Maybe Tori, you'd like to just talk about the performance.
Yeah. I mean, look, it's this performance is pretty self-explanatory. I might talk more about the downside. I've talked about how we box these transactions, getting inside the asset, lending against the liquidation value at an average LTV of 60%. It means losses are limited, and we're receiving yields of 13 to 14% on a gross basis. So very, very difficult to have a negative year or period on the back of the protection that we have. Our losses over the last 10 years have averaged about 70 basis points per year. I think as Sean alluded to before the call, it could be a very long call. I could speak forever, and I'm happy to. Later, we'll push that off for further due diligence. I think my last point to all of the potential investors on the call: full transparency is available on our strategy. Anything on a detailed due diligence review. We have 2 auditors that look at the portfolio. We have institutional top quality banks that lend against the portfolio. They're reviewing the portfolio twice a month, and they send in a field auditor once or twice a year to really go deep on everything that we do. We have a third-party valuation firm that comes in quarterly and does a review of the loan pricing, as well as we do internal reviews every month. So we're an open book. So if you have people on the line that would like to go further, they can take as little or as much as they want, and I'm happy to talk longer at that time. And maybe I'll turn it back to you to finish up.
Absolutely. I have already gone ahead and already offered your kind services to some of our institutions who are on the line, Tori. So I hope you don't mind. There might be a few calls lined up in the future. But yes, Tori and the team have been incredibly helpful. We've sat at length also with them and their credit team to learn about how they are issuing loans, how they do their credit checks. So we've also done our homework on this fund as Vela, and we're very happy with the team and how they've engaged there, and they're very willing to share the information that's needed for you to reach a decision on your investment. So please don't hesitate to ask if you need more detailed information than what's available on the fact sheet and the various FAQs. We are heading towards the end of time, so I will quickly skip through the rest of the pages, which talk a lot about what Tori's already covered, and we can get into the last couple of questions. I have been getting a few from the various DMs, so maybe I can just cover those and I'll hand them out if that's all right with you guys. How many loans does Garrington evaluate every year, and what percentage of those do you actually end up giving funding to? How selective are you?
Yeah, we're typically looking at 100 to 150 a month, and we'll fund on average 3 to 6 a month.
Okay, so yeah, really low, sort of single digit percentages of what?
Yeah,
what
5 to 7% typically. Yeah.
Okay. Yeah, I think that does also just speak to the win by not losing strategy. I know when we initially spoke, it was interesting. You know, a lot of I think funds you'll talk to, and they'll kind of take any check that you'll write for them. And I remember in our early conversations, you were like, well, look, we can take 100 million, but if it starts getting a bit more than that, we might need to to pace things out and so on. So I think that realistic strategy of we're prepared to lend, but not at any risk level is comforting to many investors.
And on that point, Blake, like, this is an incredibly lucrative time to find loans in our space. So we're seeing an abnormally high level of really good quality loans, better than we've seen over the last decade. It's a really, for whatever reason, economy, turmoil, whatever, there's lots of opportunities. But I've made it clear to you and Sean and other investors, there will be times that we will do special distributions back, and we will, if we do not see the opportunities. You've met our credit team; they will not put loans out. The money will go back to investors, and it's both a good and bad thing. But it's a reality that I would think once or twice over the next decade you'll see a special dividend check come back.
Rebecca, this was a very important point for us when we effectively chose to do this token with Garrington. A very important point, right? I could have come to market with a token backed by a brand name fund out of the US, a BlackRock or whatever they might have been. I could have just gone and said, listen, we'll buy a fund on the market, buy it on an exchange, buy units in the market, and brought it to the market ultimately blind. But the yields on that were a bit low. The returns weren't quite where they should be. And when we really deep dived into the Garrington portfolio, to realize that we could get between, and he tracks this 8 to 10, which is an important point to tell people, obviously has variation, and it obviously has its variations on a year-on-year basis. But when you look at the risk versus that the portfolio has in it, completely senior secured, 6% LTVs, first lien on loans, cash flow coming through, almost 15% of the whole total fund in cash coming through on a monthly basis, ability to offer liquidity. These are the kind of decisions that swayed us in terms of going with the fund. We're like real material questions. Very different to the ability to get inside and do a detailed due diligence on some of those really big funds with the really big private credit lenders that have perhaps got 10 or 20 billion of funds under management, where it's all sort of spread and you can't quite see what's going on in the platform. Effectively, that's why we felt this team was so good on doing it.
Yeah, absolutely. Another question I've got is, and maybe Tori, Sean, you guys can answer a little bit of both of this. I know when we initially looked at the opportunity, what gave us quite a bit of comfort is who we'd be investing alongside with, and the type of investors that are contributing to the strategy. So Tori, I don't know if you want to maybe talk about in the broader capital that you're managing, who are the LPs into that, and who is also contributing to this strategy, and what type of investor profile are customers of Valor and others going to be effectively contributing alongside?
Yeah, it goes right across the board, from very large pension funds that have 25, 30 million with us. We've got some large asset management companies, a company out of Europe with north of 10 billion that spent a year doing diligence on us, probably 2 on-site visits, couple hundred diligence questions, and they allocated about a year ago to well-known global asset management firms that are making it available for their high net worth clients. It's sort of a mix of those 3 types of investors.
There's also South African pension funds too. I mean, obviously we can't give you the name specifically of who they are till we sign the NDAs. But I mean, we gave those to you. But I think there are, just to put the South African audience at pace, there is also South African pension funds that have allocated to the strategy. I can't remember whether I know that, round about those multiple tens of millions of dollars that they've allocated towards the strategy as well, from a research point of view that was done here.
Yeah, I'll save it for we're out of time, but there's a massive commitment from Garrington to South Africa. It's been a pleasant surprise for us in the sophistication of the market versus the other private credit funds in the market. So we're putting a lot of time, effort. We're launching a regulated product, QIF product in South Africa. We have other products rolling through. It's a really important region for us.
Yeah, amazing. I know, Tori, we actually met in South Africa, and it's been clear to see your team's commitment to this as a market. Of course, Valor serves a number of markets, and this product is available to our global customer base. But of course, our home being here in South Africa, it is great to have seen you guys on the ground and have met Gary and the team regularly down here too. So thank you for that. I think we are out of time, so I will call it here. But I see there's one more question here from Rob. It says, apologies if this has been answered, but how does a special payout or dividend work for the token holders? Sean, this one would be for you. If there are funds returned through the
yeah, that's a really good point. I think we haven't structurally worked that out. Like for our other funds, we would just return so many units back to them. It'd be like a forced redemption, I think, would be how it would work. We haven't talked about the structural impact. That's how we would do it for a normal fund. So I think you would do a forced sale of the units at net asset value is how I would anticipate it.
That's exactly correct. So we would As the ECP is a large investor in the fund, the ECP would then have effectively its units redeemed by the fund, Blake. They would buy them back. We would then have the cash. We would have to redeem from the customers. The customers would obviously redeem at that point in time, give them a value for the redemption.
Yeah.
And,
Yeah.
my
Most likely we would have. Go for
Go
it.
ahead.
Sorry.
No,
I was going to say in these scenarios they're normally the edge cases, but there will be several large customers that are heavily involved with holding these assets, and typically they would be redemptions and so on might be processed with those larger investors rather than with lots of small investors. But I'm sure Tori, you can carry on.
No, you're 100% right.
Yeah, so I think if there aren't any other questions, I will wrap it up and just thank you very much for your time, Tori and Sean, and for giving us this opportunity to distribute this product. We're really excited about it, and we hope this will be one of many such types of products that we do together, and we look forward to the future. And thanks everyone for dialing in. We will release this recording, and of course, if you have any questions, please send them in to us on help@vela.com or otc@vela.com. Have a look at our website. You can subscribe and redeem via a form that is conveniently located on our FAQ site. So if you just type into our support site, USDPC, you'll find the link to subscribe, or send in an email to us and we'll answer it. But thank you very much, and good evening, and thank you very much for joining. Cheers, everyone. Bye.
Thanks, everybody. Thanks, Tori. Thanks, Blake. Have a good day.